The average American making $75,000 a year often believes they can't afford a home, especially with today's interest rates and rising prices. But here's the shocking truth. You absolutely can. It's not about what you earn, but how you manage it, and more critically, how lenders calculate what you can borrow. Many people get stuck on the 3x or 4x income rule, thinking a $75,000 salary means a $225,000 or $300,000 house, which feels impossible in many markets. This outdated rule ignores so many critical factors, from your actual debt to your credit score, making it a terrible predictor of your true buying power. In this video, we're going to pull back the curtain on exactly what a $75,000 salary can realistically buy, based on what lenders actually care about, not just old rules of thumb. The numbers might surprise you, but first, let's break down the single most important factor that lenders scrutinize. The most crucial factor for lenders is your debt-to-income DTI ratio, specifically your back-end DTI. This ratio compares your total monthly debt payments, including your proposed new mortgage payment, credit cards, car loans, and student loans, to your gross monthly income. Most lenders prefer a DTI of 43% or less, though some FHA loans or credit unions might stretch beyond 50% for strong applicants. Let's crunch some numbers. A $75,000 annual salary is $6,250 per month gross. If your DTI limit is 43%, your total monthly debt payments, including the future mortgage, cannot exceed $2,687.50. This figure is your absolute ceiling for housing costs and other debts combined. Understanding this number is step one. But what exactly goes into that housing cost calculation? When we talk about your monthly housing cost, it's not just the principal and interest of your mortgage. Lenders use an acronym, PITI, which stands for principal, interest, taxes, and insurance. This is the real monthly payment. Property taxes can add hundreds of dollars. Homeowner's insurance is mandatory, and if your down payment is less than 20%, you'll also pay private mortgage insurance, or PMI. For example, a $250,000 home with a 7% interest rate and a 30-year fixed mortgage, assuming a 5% down payment, might have a principal and interest payment of about $1,630. But add $300 for property taxes, $120 for homeowner's insurance, and another $100 for PMI, and suddenly your PITI is $2,150. That's a huge difference from just the principal and interest. Now, let's see how much house that $2,150 PITI payment actually allows on a $75,000 salary. Alright, let's put it all together. With a $75,000 salary, your gross monthly income is $6,250. Assuming a 43% DTI limit, your total monthly debt payments can be up to $2,687.50. Now, let's factor in existing debts. Say you have a car payment of $350 and student loan payments of $200. That's $550 in existing debt. Subtracting that from your DTI limit leaves you with $2,137.50 for your PITI payment. Using current rates, if your PITI is $2,137.50, and you factor in typical property taxes, insurance, and PMI, you're likely looking at a home in the range of $280,000 to $320,000. This is significantly more than the $225,000 that a simple 3x income rule would suggest. This range is for a 30-year fixed loan at around 7% interest with a modest down payment. But this isn't the whole story, because there's a huge upfront cost many first-time buyers completely overlook. Beyond the monthly payments, the down payment is often the biggest hurdle. While 20% down is ideal to avoid PMI, it's not always necessary. FHA loans, for example, require as little as 3.5% down. On a $300,000 home, that's $10,500. VA loans, available to eligible service members, often require no down payment at all. Even conventional loans can go as low as 3% or 5% down. So, for that $300,000 home, a 5% down payment would be $15,000. While this is a significant sum, it's far more achievable than $60,000. Many states and local programs also offer down payment assistance. This can be a grant, a second mortgage, or even a forgivable loan. Don't let the 20% myth deter you. However, the down payment is just one piece of the upfront cost puzzle. There's another major expense that can blindside buyers. Here's where many first-time homebuyers get caught off guard. Closing costs. These aren't part of your down payment but are essential fees paid at the close of the transaction. They include loan origination fees, appraisal fees, title insurance, attorney fees, recording fees, and prepaid expenses like property taxes and homeowner's insurance for the first few months. Closing costs typically range from 2% to 5% of the loan amount. On a $300,000 home, this could mean an additional $6,000 to $15,000 out of pocket. This is money you need to have saved in addition to your down payment. Forgetting to budget for closing costs is a common mistake that can derail a purchase even after pre-approval. So, if you're saving for a $15,000 down payment, you should really be aiming for $25,000 to $30,000 in total savings to comfortably cover both the down payment and closing costs. But what if your credit isn't perfect? Your credit score plays a massive role in how much house you can afford, primarily by influencing your interest rate. A higher credit score, generally 740 plus, can qualify you for the best rates, while a lower score, below 620 for conventional or 580 for FHA, will mean a higher interest rate or even make you ineligible for certain loans. For example, on a $250,000 loan, even a 0.5% difference in interest rate can cost you an extra $75 to $100 per month, adding up to tens of thousands over the life of the loan. This directly impacts your PITI and, therefore, your DTI. Improving your credit score by paying bills on time, reducing credit card balances, and avoiding new debt before applying for a mortgage can save you substantial money. But what if your DTI is too high even with good credit? If your DTI ratio is too high for the house you want, there are concrete steps you can take. The most straightforward is paying down existing debts. Aggressively paying off a car loan or credit card balance can significantly reduce your monthly debt obligations, freeing up room in your DTI for a larger mortgage payment. Another strategy is to increase your income, perhaps through a side hustle or a raise, though this often takes more time. You could also opt for a longer loan term, like a 40-year mortgage if available, which lowers monthly payments but increases total interest paid. However, the most effective method, especially for those close to the DTI limit, is to focus on reducing high-interest debts. This not only improves your DTI but also strengthens your overall financial health. But what if you don't even know where to start with the mortgage process? The very first step in the home buying journey, after understanding your finances, is getting pre-approved for a mortgage. This isn't just a suggestion. It's a necessity in today's competitive market. A pre-approval letter from a lender tells sellers you're a serious, qualified buyer. It also gives you a clear understanding of your maximum loan amount, allowing you to focus your home search within your true budget. To get pre-approved, you'll need to provide documentation like pay stubs, W-2s, bank statements, and tax returns. The lender will review your credit report and DTI. Don't confuse pre-approval with pre-qualification. Pre-approval involves a deeper dive and a hard credit pull, providing a much more accurate picture of what you can borrow. This step also reveals if there are any financial issues you need to address before seriously looking at homes. But what if the market changes right after you get pre-approved? One of the most volatile factors impacting your affordability is interest rates. Even a small increase can significantly change your monthly payment and, therefore, how much house you can afford. For instance, if you were pre-approved at a 6.5% interest rate, and by the time you find a home, rates have climbed to 7%, your monthly payment on a $250,000 loan could jump by $75 to $100. This could push your DTI above the acceptable limit, meaning you can no longer afford the same priced home. Lenders offer rate locks, which guarantee your interest rate for a certain period, typically 30 to 60 days. It's crucial to understand these options and their costs. While locking a rate provides certainty, it also means you're committed to that lender for that period. The best strategy is to stay informed about market trends and discuss rate lock options with your lender. But there's a common trap many buyers fall into once they get pre-approved. Here's a major mistake many first-time buyers make. After getting pre-approved, they go out and make large purchases on credit or open new credit lines. Maybe it's new furniture for their future home, a new car, or even just maxing out a credit card for home improvement supplies. This is a huge trap. Any new debt or significant change to your credit profile between pre-approval and closing can jeopardize your loan. Lenders often do a final credit check just before closing, and if your DTI has increased or your credit score has dropped, your loan could be denied, even if you're just days away from getting the keys. The rule of thumb is simple. Do not make any major financial moves, take on new debt, or close existing credit accounts once you're pre-approved. Stay financially stable. But what about the bigger picture of owning a home? Owning a home isn't just about the mortgage payment. There are ongoing costs beyond PITI that often get overlooked. Budget for utilities, which can be significantly higher in a larger home. Then there's maintenance. Roofs leak, appliances break, and landscaping needs attention. A good rule of thumb is to budget 1 to 3% of your home's value annually for maintenance and repairs. For a $300,000 home, that's $3,000 to $9,000 a year, or $250 to $750 per month. Not having an emergency fund for these inevitable expenses can quickly turn homeownership into a financial nightmare. While a $75,000 salary can absolutely get you into a home, true affordability means being able to comfortably cover all these additional costs, not just the mortgage. It requires a holistic view of your finances and a robust emergency fund. But once you're in, what's next? So, a $75,000 salary can realistically afford a home in the $280,000 to $320,000 range, especially by optimizing your DTI and understanding all the costs involved. The key is thorough preparation and avoiding common pitfalls like overlooking closing costs or making new debts. If you're now wondering how to actually find the right lender or navigate the different loan types like FHA versus conventional, you'll want to watch our video on choosing the best mortgage lender for first-time buyers next. It walks you through exactly what questions to ask and red flags to look for. And if you found this breakdown helpful, hit that subscribe button for more real estate insights that skip the hype and get straight to the facts.